Okay, let's get started. 11:01. We have a lot of folks on the line, and we have a lot of material to cover. But my name is Tom Citino. I'm the Director of Member Relations with the Home Loan Bank of New York. And today's topic is a credit union-specific topic. So like I had said a couple of seconds ago, if you're from a banking organization, it may not be very useful for you to listen in. This is regarding a supervisory test that's credit union-specific called the NEV Supervisory Test. So today's presenter is Frank Farone. He's a managing director with Darling Consulting Group. And I've known Frank for around 11 years, but he's been working with the system for many years. He used to be part of the Federal Home Loan Bank of Boston, and he's been with Darling Consulting for many years, working with credit unions across the nation, hundreds of credit unions across the nation, and he consults with them regarding asset liability management and how to optimize their balance sheets. Also works with them very closely resolving regulatory issues. So the title of today's session, the NEV Supervisory Test, the perfect storm has arrived with a vengeance. That is true from a home loan bank standpoint. I speak to credit unions all the time, and this is on the forefront of everyone's mind. Also, in the past, Home Loan Bank of New York has provided products and services in order to help credit unions solve or resolve NEV issues. So we'll talk about that at the end, and Frank may touch upon them. But we have products to bring your balance sheet back into alignment and to alleviate some of the NEV pressures that may exist to your organizations today. So with that, let me turn it over to Frank Farone. Good morning, Frank.
Good morning, Tom. Good morning, everybody. The NEV Soup Test is a perfect storm. It has arrived with a vengeance, and it's only going to get worse. And so I think the timing is probably as good as ever to have this session today. I've got a lot of material. I'm going to go through things relatively quickly, but this is going to be recorded. So if you want to play back, call the Home Loan Bank. So here we are, the current environment. What's happened since year end? A lot has changed since year end. And hopefully you can follow my cursor. But if you look at this yield curve, or this series of yield curves that I've got up on this slide, look at where we were as of 12/31, end of the year. If you look closely, you'll see the 10-year was at about 1.5. Today, we're over 3%. One of the things that you've heard me say over and over again in the webinars that I've done for Federal Home Loan Bank in New York, our own webinars, and FMS, and the list goes on, I've always said long-term rates in anticipation of short rates, both on the way up and on the way down. So if I were to ask you the question, what's happening here? Why has the yield curve steepened so significantly? If I were to put another yield curve in here as of September of 2021, you would have seen a relatively flat line, because back then the expectation was the Fed wasn't going to hike in 2021. We had this transitory inflation. We weren't going to see Fed hikes. All of a sudden, the expectation, Powell pivoted, long rates snapped up as of 12/31. They snapped up again as of 3/31. Most of you today have already had your 3/31 ALCO reports produced. And what you're finding now is this NEV Soup Test has gone from one category to at least one, and maybe even two. When you run your June 30 NEV Supervisory Test, rates are today around where they were as of May 1st. What you're going to find is that NEV Soup Test has put you into a category that you had never dreamed possible, given your interest rate risk position. So the question becomes, what's going on? Why is the curve so steep? It's expectations for higher Fed funds rates. So we're likely to see a flattening yield curve ahead, and that is even worse for this soup test. Meanwhile, what's the impact to your earnings since the end of the year? Earnings are higher, margins are wider, life is good. So effectively, these are the best of times and the worst of times when it comes to the NEV soup test. So as far as the outline is concerned, I'm going to go through the basics of what NEV is. And we all know it's a liquidation calculation. It's a snapshot in time. And I'm going to show you a real world approach what the banks have to do, what credit unions used to do, and what drives the valuations for this test. And then I'm going to go into the NEV Soup test, and I'm going to demystify this test and explain to you why it is a concept that is seriously flawed. And by the way, the same thing I'm going through with you today, I went through the examiners with. I've been going through this with them for the last few years, last several years, and they've seen the same presentation. And by the way, they don't disagree, most of them, right? We are now in the eye of the storm. If you haven't received a document or resolution, it might be soon coming your way. I had an email this morning from a credit union client that said our examination is not until October. We got an email from the examiner saying, we'd like to see your 331 ALCA report, your June 30th report, and if you are at extreme risk, we want to know what your game plan is. They're already looking ahead, looking at call report information, which tells you nothing, by the way. So the paradox is, if you fall into a high risk or an extreme risk category, if you fix that, I'll call it fictitious risk, it's counterproductive. And so our challenge here today as credit unions is, what do we do? The medicine's worse than the poison. If you fix that NEV Soup test to get you out of extreme risk down into a lower risk, it might actually only be temporary. You might get out of that high risk category or the extreme risk category down into the high risk, but you might soon slip into it in the not too distant future. So we'll talk a little bit about that. And then we'll talk about the conundrum of, if we do de-risk, how do we do it? Over what time period? And how do we go about putting a plan together? So let's just talk about NEV. What is NEV? Net economic value. It's nothing more than economic value of equity, which is what the banks have to run. Credit unions have to run net economic value. It's like Kleenex and facial tissue. It's the same thing, but at the end of the day, it's a liquidation calculation. You take the economic value of your assets in a shocked scenario, and you subtract out the economic value of your liabilities in that shock scenario of 300, and you see what's left over. So effectively, if you think about it simplistically, it's, what is the replacement cost for every asset, and what's the replacement cost of every liability? That's really what it is. It's nothing more than that. That's simple. Most of you, when you're running NEV today, you look much better today than you did a year ago, right? Or 2 years ago, when rates were significantly lower, because of the huge pickup in value on your non-maturity deposits. So your non-maturity deposits are an absolute critical assumption, right? Here's the challenge. And I think this is the reason why they came up with that soup test, is there's no contractual life. So you have to estimate valuations, meaning you have to estimate the premiums, ultimate premiums of those non-maturity deposits. It's based on several factors: how sensitive they are, how long they are, what the average lives are, what the betas are, what the decay rates are. We all understand that. In my experience, when I first started working with credit unions, I used to see these average lives of 2.5 years. Where did you get 2.5 years of an average life of a non-maturity deposit? Well, that's what the regulators wanted us to use. Or it came from a NERA study, or Dr. Brick, or some of these other vendors that give you these numbers because they're conservative. Farone, I used to see these 2.5 year average life. Well, that's conservative. That's not conservative. That's wrong. If you were a publicly traded bank, you couldn't take a number like 2.5 years and plug it into your EVE calculation for transparency purposes for shareholders. It's got to be reasonable, rational, and reflect rational expectations. But in the credit union world, we tend to look at things a little bit differently. Now is not the time to have conservative estimates. So I'm not going to go into the detail here, but a lot of this for some of us might be Greek. And that is, how do you calculate market values for non-maturity deposits? I'm going to take one account. It's a regular share account. And all of these numbers are not important, but if you want to look at them, be my guest. Go through them. Betas, how much do these accounts move? So I took this from a client that used these really odd numbers. And we were like, where did you get these numbers from? we did a deposit study, and we came up with very, very different numbers. So what goes into calculating the value and ultimately the premium of non-maturity deposits? This one account, it's the beta. How much does it move? Their savings account, 10%. What's the average life? About 7.5 years. How volatile are these accounts? What's core and what's non-core? And you can look at this on your own to see how we go about calculating that, what's core, what's non-core, and then what's the decay rate. So that's one account. If you think about it logically, if you want to get the numbers right, both for earnings and for value at risk, average life versus effective beta. Think about this logically. If you were to choose, based upon all those variables, which are the most valuable accounts, liabilities that we have in our balance sheet today, and if you think about the variables we've discussed, average life and how much those rates on those deposits move in rising and falling interest rates, clearly, if I'm paying 0 on a DDA and it has an average life of 6 years, that's pretty darn valuable, right? A share draft has a very long average life. That's a checking account. And the beta on that is very, very, very low. So that's got to be one of your most valuable accounts. Conversely, the farther out we go, money market accounts, those are more rate sensitive and their average lives are shorter. Pretty simple. But the combination of those two makes a big difference when you're putting together a value. If you were a bank or you were selling a branch, this is all the analysis that you would come up with in order to sell or transfer those liabilities. When it comes to the NEV Soup test, all of these accounts are exactly the same. How much you pay on your money market, 125 basis point money market account today, that's volatile and moves aggressively with market, has the same value as a DDA. It has the same value as a share draft account. Therein lies the problem, right? So 7.5 year average life for this one particular credit union. I'm not going to go through this, but you can look at the average lives. And if I were to ask you of those, which ones were the most valuable, you'd probably say share drafts. So let's take that and let's look at a net economic value calculation. Everybody's familiar with this. This is what we all were used to prior to this NEV Soup test that came out of nowhere. So sometimes looking at pictures is a lot easier. Look at the net economic value of this particular credit union. The higher rates go, the more valuable the organization. What drives that? Primarily, it's the value of these non-maturity deposits. Well, think about the book value. You've got $3.2 billion of non-maturity deposits. If you were to calculate a little bit over a 10% premium, and this was back in 17 when rates were low, 2.9. Well, 2.9 is a smaller liability than 3.2. Therefore, that's a gain. You want a smaller liability. So there's a $300+ million gain in the value of those non-maturity deposits. The higher rates go, some of these deposits don't move at all from a rate perspective. Some move a little bit. At the most, and you can see it on the previous page, they might move 50% of the rate movement, let's say a money market account. But the higher rates go, the more valuable they are. Why? When I said earlier, it's the replacement of those liabilities. So for example, and it's usually used the Federal Home Loan Bank curve. If I took a 7.5 year average life share draft account that I'm paying 5 basis points, that in an up 3, maybe I pay 25 basis points. If I had to replace that, what would it cost me? Well, if a 7-year Home Loan Bank advance rate today is 3.5, a 7-year is in an up 3, right? Let's say it's 3.5. I add 3. That's 6.5. If I had to replace a 6.5 year average, if I had to replace this with a 7-year Federal Home Loan Bank advance at 6.5%, think how expensive that would be. So the fact that it's such a low rate, I get a huge gain because I think the difference between 25 basis points and let's say a 7-year borrowing at 6.5, that's 625 basis points times 7 years. That's a huge gain. That's a huge value. You don't get that in the Soup test. So if we look at this one credit union and we look at where's the greatest exposure to rates from a value perspective? It's the falling rate environment. That's true for you. That's true for banks. The higher rates go, the more valuable we are, right? In this case, right, their worst case scenario is falling, but they're still at minimal risk, NEV, right? Now, let's look at earnings, because I just showed you value at risk. Now we're going to look at earnings at risk. Look at the same credit union. If I run rates up 300, income goes higher and higher and higher and higher. Where's the real exposure to this credit union? Oh, it's for the first 6 months because they move their deposits immediately. How many of you have moved your deposits on the non-maturity deposits since the Fed raised rates? Probably none of you. And if you did, minimally. The reality is you haven't moved them. So the higher rates go, the more valuable. Higher rates is the best case scenario for credit unions. Think back to 2020, 2021, when rates were low. Challenging times. So we're going to leave the real world of economics. Now we're crossing over into what I call the twilight zone, which is the NEV Supervisory Test. The root of the problem for this test is you get prescribed premiums for non-maturity deposit shares. You get a 1% premium in the base case scenario. So if somebody were to come to your credit union today and say, you've got $100 million of non-maturity deposits that you're paying an average of 15 basis points on, I'll tell you what, I'll pay you $1 million premium to take those off your hands. Would you sell them? Especially if they had an average life of 7 years? Well, if a 7-year borrowing today is $350 and I'm paying $315, I'll just say 3% premium for 7 years. That's a 21% premium. You want to give me how much? 1%? No way. If rates go up 300 from here, you get an extra 4% premium, according to this NEV Soup test. That is nowhere near the value of these non-maturity deposit shares. Meanwhile, run your loan rates up 300, run your securities up 400, right? Look at the loss in value on those. So, it's a one-way street. Heads I win, tails you lose. So I'm going to show you the same credit union. I call it the tale of two different credit unions. It's the same credit union. One is based upon the real world, NEV. The one in the bottom is the NEV Soup test, where the NCUA defines the value of these non-maturity deposit premiums. So in the zero shock today, if we were to liquidate this credit union, you'd have 21% capital left over. Let's go over to Twilight Zone, zombie world. NEV Soup test using their 1% premium. Now we're only at 5%. Where's the other 16%? You don't get the value. If I have non-maturity deposits, 4.9 billion, it's 4.89 billion in the zero shock. That's the 1% premium. So you multiply the book value times 0.99. There it is. That's selling your low cost, no cost non-maturity deposits for a 1% premium. None of you would do it. Let's go up 300. I showed you the earnings of this credit union in the up 300. When we look at the value in the NEV Soup test, all of a sudden what happens? Now we decline, the percentage change in our net economic value drops 75%. All right, so we go this is like playing bingo with NCUA Soup test. You go over here, what's the post-shock NEV? Right, it's below 2% at 1.9, and it's got volatility in the high range, but it doesn't matter. You take the worst of the two. So even though it's 75, it's high, you fall into this category. You are now served a documented resolution. You are considered to be unsafe, unsound. That goes all through the documented resolution, and you need to come up with a plan. And you better be out of this thing in 6 months. What do? I probably have 15 of those documented resolutions sitting on my desk right now. And every day I get another one. It's a serious, serious problem. So same thing, right? If this is another credit union, right? And I'm not going to go through the math again. It's just another example of a credit union that, I work with. And when we look at their NEV Soup test, say, okay, we're not extreme just yet, but as of 3/31 in the up 3, if I were to run this test today, given the rates I showed you earlier, we're up significantly in the yield curve, then I'm going to look at 331, but I'm going to go up 400, not 300. This now becomes the new up 300. All of a sudden now we've got problems. Now we've got problems. Our capital goes to 1.1%. And I can tell you, this credit union, their earnings, their margins, everything is humming along. And they've got strong loan demand. And here's the problem, right? It's the conundrum. It's the paradox. I've got all this demand, but I can't manage that demand for loans because every loan I book today, I get whacked on the NEV Soup test. So what do we do? And by the way, I mentioned this earlier. I showed this same presentation to the regulators. The NEV Supervisory Test, I told them it's a major disaster. So here's the good news. Rates now are rising, our margins are widening, earnings are higher, life is good. This is nirvana. But this soup test is a nightmare. We've got higher income, lower valuation. We're looking at the balance sheet under the soup test as a liquidation under the worst case scenario. I've taken my credit unions that are extreme risk and I've run the stress tests that the big banks have to run. And you know what? We're fine. But in this, so in other words, if I were to take the banking industry, apply the same test to them, well, we'd have no banking industry. So why is the NCUA insist on using this? I think they made a big mistake, didn't understand the unintended consequences of this, and they're afraid to back off. Nobody knows what to do. It was like the old mark-to-market accounting issues. All right, so we sent all of our clients an alert on this test. There's a video down there, but you're going to get a replay of this, so you don't need this. But if you want it, I'll send you what we sent. And we sent a white paper to our clients. I've got a lot of clients on this call right now, so they've already had this. Anyway, so what are the issues in this soup test? Right? Number one, it's a one-size-fits-all approach. All the things that we talked about that go into valuing a non-maturity deposit doesn't matter. It doesn't matter, right? If you have a 5 basis point share account with a long average life, it gets the same valuation as a 1 1/4 high yield money market account that's very rate sensitive, right? Everything's fixed. We walk through that. And one of the things I'm going to show you in a minute is this concept of free beer tomorrow. If you were to go to a pub and it says free beer tomorrow, and you came back the next day, what would that sign still say? Free beer tomorrow, meaning what? Tomorrow never comes. They give you these premiums in the rising rate environments. Until that rising rate environment arrives, you don't get that. It keeps moving. What you have to do is you have to start all over again. And therein lies the problem. Meanwhile, all your asset valuations get whacked. So the non-maturity deposit premiums versus average lives. If I were to say to you, you're driving down the street, you see gasoline, $5.50 a gallon over here, and it's $1.79 a liter over at this gas station. Where do you go? Well, you get your calculator out, figure out, okay, what's my break even here? How many liters in a gallon? It's the same thing when you look at your non-maturity deposit premiums in that soup test. So if I were to convert these prescribed premiums in the soup test, your non-maturity deposits come out to about 4 months. About 4 months. How do I get that math? Let's assume that I'm going to assume a very conservative number. You have 5-year average life on your non-maturity deposits. You're paying 15 basis points. If I had to go to the home loan bank or the broker, it doesn't matter, and I had to borrow 5-year money, it would cost me $3.15. So in other words, I save 3% a year, every year for 5 years in the base case scenario. How much do I save the first year? Well, 15 to 315 is 300 basis points. So you're telling me, even though I save 3% cost the first year, you're only going to give me 1% premium. So I take that 1% premium, 1% versus 3%, one third of a year is 4 months. So would you consider the average life of your non-maturities 4 months? No. So that's the problem, right? And if I went too fast, I'm sorry. I'm going to hit the rewind button. I'm going to go back to the last time we did a webinar for you. And one of the things I warned against back then, we had this backup in rates, and this started to become an issue. And I warned against taking action because if you went back to the end of 2018, when rates snapped up, right? And we had it's like deja vu. All of a sudden, when you look at income, forget about that NEV soup test. Look at income. Where was the greatest exposure? This is listening to your balance sheet, right? Your greatest exposure was if rates fell 200 or if they fell 200, steep, boom. But not only did we come down we came down more than this. So meanwhile, the soup test is saying you got to protect against rising rates. You got to shorten assets, extend liabilities. When my income looks like this, same situation we have today. Don't get sucked into extending liabilities and shortening assets today if your balance sheet suggests otherwise. You need to fight this thing, and I'll show you how. Okay, sometimes you have to do the opposite, right? So again, case study. I look at 12/31/21 when life was good, low risk from the NEV soup test, and I look at my income. I have exposure to falling interest rates back then. Rates were low. The higher rates go, the better off I am. I roll the clock forward to 3/31 and look at the difference between December and March. Look at the change in income at the bottom of the page. My income, this credit user income, is significantly higher. Look at the difference in the base case scenario. Here, we're kind of treading water. Over here, now that if rates stay exactly where they are with a steep curve, life is good. Life is good. But we're not looking at ongoing. We're looking at point in time, and we're looking at this soup test, which, again, gives you bad information and miscalculated valuations. You have probably seen this because I've used this for the last 20 years. I just keep updating it. And one of the things that you've heard me say 1,000 times is long rates move ahead of short rates. Look at where we were in 2018. That's the last time that this was the big issue. Probably the first time it was the big issue because they came out with this thing in 17. So at the time, long rates moved up, the Fed was tightening, and the next move was likely to move down. It's cycle after cycle after cycle, as if you've heard me before. Long rates peak about after the third Fed hike. The Fed tightens too much, long rates come down, we go into recession. I think that's where we are today. But this is going back to 2019, into the end of 2018. That's kind of where we are today. Don't fall into that same trap. So one of the things I want to show you is if we went back to 2018, when this first became an issue, and when we went to the regulators to talk about this issue, and I have a client in Washington, in Alexandria, Virginia. Every time I would go to see them, I'd go to the NCUA. I wouldn't tell them I had a client in the market. I'm coming down to see you guys, right? So we went through this math, and they looked at each other and they said, yeah, well, Frank, it's just a scoping tool. It's just a scoping tool. It's not a scoping tool, right? It's a problem. So if you went back to 2016 and we looked at, now follow me here, we looked at the NEV soup test for this credit union. This is the free beer tomorrow concept, which is important to understand when you argue your points. So book value, $395 million of deposits. In the base case scenario, I get a 1% premium. Well, what's 1% of 395 million? 3.9, right? So 391. Okay. How about if rates go up 200? Now what do I get for a value? Well, now it drops to 379. So in other words, I get a $16 million gain in the value of my non-maturity deposits if rates go up 200. Yep. Okay. So what were the rates that we paid in 2016? Well, our non-maturity deposit costs were 24 basis points. And this is where wholesale rates were, 84 to 113, right? Roll the clock forward. I'm going to show you the next page. As of 9/30/2018, that's when rates were up. Our non-maturity balances grew up by 35 million. No big deal. But look at the cost of our non-maturities. They actually dropped to 19. So shouldn't they be more valuable? Because rates went up 200. And I'm going to show you in the next page. Rates went up 200. My cost of my non-maturities went down. So theoretically, it should even be more than 16 million. So let's see what happens. Oh, what happened? Now I'm going to show you, we rerun the study as of 2018. And now that rates are 200 basis points higher, I have to start all over again. In the base case scenario, which is now 200 basis points higher than where we came from, I only get a 1% premium. So I get a little over 4 million. Where did the other 12 million go? I get a $4.3 million gain in this higher rate environment. Where did the 16 million go? And by the way, now I'm in extreme risk. Right? That's the root of the problem. And that's one of the things that you need to understand if you're going to be defending yourself against this supervisory test. So that's the free beer tomorrow concept. But I've used this slide with them, right? So you can't say that they're not aware of this. They're fully aware of this. And we've had ongoing dialogue recently. And we had a meeting set up with them again any day now, which got moved a month. So the good news is we're going to be using June numbers, right? The next time we sit down with the regulators to go through this again. They've got to change this thing. It's just wrong. It's just wrong. And it puts you at a huge disadvantage. So let's go through a case study, all right? We got about 15 minutes. Let's go back to 12/31/2021. Look at the earnings of this credit union on the right. And I highlighted it in red. If rates stayed the same, our earnings were not improving. And if rates fell, they're going down. Rising rates is our friend. We're probably somewhere close to this rate environment today. Roll the clock forward to 3/31. Now my earnings are higher, driven by higher yields, steeper curve, and a little bit of growth. If I were to ask you, you've got some money to invest. Do you invest in that institution on the right, or do you invest your money in the institution on the left? Well, depends, right? This institution over here now, we went from low risk to extreme risk. What happened? Why are we at higher risk today than we were before when income is higher? We're not looking at the organization or the credit union as an ongoing concern. We're looking at it in liquidation form using unrealistic calculations. And here you are. Right? Once again, look at this institution. Falling rates and base case rates as of 3/31/21, that was a year ago. That was bad. They were at low risk. Look at where we are 1 year later. Isn't everything better today than it was a year ago? No. Earnings are better, but the NEV Soup test puts us from low to extreme. So I'm not going to walk you through all this, but if you believe that the most likely scenario moving forward is that we have a flattening curve, I think the numbers came out today. I read a bunch of reports this morning. The expectation is that Fed funds is going to settle in about 3 5/8 at year end. You know what? That doesn't mean it's going to. Market's always wrong, but let's assume that's the case and we get a flattening yield curve. All right, we're still okay. We're still okay. You run your soup test in that category, not very good. And if I were to ask you, how are you going to price your non-maturity deposits this time around? I would go back to, and I would look at the last cycle. And the last time Fed funds was at 250, the 10-year treasury was 305. Sound familiar? Deja vu, right? If I run our scenario, I model up 200 and I flatten it, our expectation is for this credit union, they're going to end up about 65 basis points for their cost of funds for non-maturities. The last time that happened, sure enough, 63 basis points. So our assumptions, we feel comfortable with the assumptions. And so the following betas for this particular credit union, they had in their model that they were going to move much more aggressively than what they actually did last time. So obviously we had to go back and revisit and change some of those assumptions. But this has nothing to do with NEV Soup test. But the reality is higher rates is our friend. And make sure you understand the impact of a flattening yield curve environment, because that can actually be worse than a steep curve when it comes to the NEV Soup test. So let's look at the total balance sheet, not just unrealized losses, the investment portfolio. Let's take a look at this credit union. How do we look? Well, we've got lots and lots and lots of capital right now if we liquidate. The higher rates go, life is pretty good, right? If I were to look at NEV Soup Test trends, and I go back to the first quarter of 2021, about 2% of credit unions had extreme risk. As of the first quarter of this year, it's 12%. Look how much the high risk moved up from 8 to 20. If I were to include today's yield curve or recalculate these things, in other words, if I show you second quarter 2022, when those numbers come out, these are going to be significantly worse. And that's why I have at the top, June, it's going to be bad. Meanwhile, earnings are higher, margin, everything is better, with the exception of the NEV Soup Test. So I'm telling you, it puts you in a very difficult position. The NEV Soup Test risks are rising, and they're rising fast. I don't have the time to go through this, but look at the changes in rates, right? And I highlighted the biggest issues with the soup test and what's creating the problem. You can go through that at your leisure. If I were sitting at ALCO, or those of you that work with me, and we have our ALCO meetings, what are the things that we ought to be talking about at ALCO from a strategic perspective? And I'm going to just go through these like this. These are the things that we might talk about on deposit pricing, for liquidity management, for investments. You should be asking these questions. Loan strategies, what should we be doing? If I'm a credit union right now, I am going to be pre-investing cash flows in the investment portfolio, taking advantage of high yields, bonds at discounts. I'd be holding fixed rates. I'd be extending duration. I'd be doing all of these things if I didn't have to worry about that soup test. And that's why I put the caveat in here. When we ask these questions at ALCO, make sure you understand what's the impact on the soup test, every single one of these. And that might influence some of the things that you do or you don't do. And again, we don't have time to go through all that. One of the things I think is important, again, to defend your position with the NCUA and with your board. You know, if your board sees this and they read that document of resolution from the NCUA that says you are operating in an unsafe, unsound manner, how do you react to that? Right? So knowledge is power. I'm not going to walk through these, but the most important thing here is if you believe that rates could go up 300 basis points, and you look at that NEV soup test, let's go back to 04 and 07 when rates went from 1% all the way up to 5.25. So you take today's Fed funds rate and you add 3, right? And ask yourself, if that were to occur, what did the industry pay for non-maturity deposits back then? And this should, all right, we've got 7 minutes. Where would we be, and where would we land from a cost perspective? That's what this is. It goes beyond a deposit study. It's a forecasted deposit study. And again, same thing here, right? Again, we don't have the luxury of time, but go through this, and if you have questions on it, let me know. But what it does show you is that as rates rise, and this is effective Fed funds, right? As rates rise, the higher rates go, the higher the probability long rates start to fall. But look at the lag between non-maturity deposits, right, versus Fed funds. You don't get that value in your NEV soup test. So what do we do if we're at extreme risk? Well, we can hedge. And by the way, I actually received two calls from credit unions in the Federal Home Bank New York district that said, we're at extreme risk, and this is what we were told to do by our advisor, right? Neither of which I would ever recommend, because all you're doing is you're caving into the regulators, you're exacerbating your risk, you're taking on additional risk to solve a problem that doesn't exist. And if you want to do that, I think there's better ways of doing it. So this is, and by the way, this was one of my clients that was at extreme risk back in 2018, November of 2018. Rates snapped up, all of a sudden, bang, extreme risk. And so if you look at their interest rate risk profile, right, we didn't have a lot of exposure to rising rates, very little exposure to rising rates. But the NEV soup test, extreme risk. So you have to put a plan together. How are you guys going to get out of this? And my recommendation to you is put together a plan that shows over time how you get through this, right? Through earnings, through restructurings. And if you run that up 300 shock scenario, which is the first thing I would do, I would look at all the incremental income that you get. I would factor in my growth. I would take that income and I'd add it to my capital when you do your forecasted NEV and forecasted NEV soup test, right? And then I'll show you some other things that you can do. So here's the question. I can calculate how much I have to do and for what term, right, to get out of this. And for this client, it was putting on a $75 million 5-year pay fixed swap to get from extreme to high. Here's the problem. The problem is, what happens if we're wrong about the direction of interest rates and rates fall and we're stuck with this thing? How would you like to be stuck with this? It was 273. Excuse me, it was 256 at the time. Paid 256. How do you think they would have felt in 2020, 2019, 2020, 2021, and even today, paying a rate of 256, right? They didn't need the protection, but all of a sudden it takes that risk away. It's like deja vu. This is where we are now. And if you're going to take that same action, and I'll show you what the cost is, right? You better be prepared down the road to live with this thing, this high cost funding that you probably don't need. So if I did put that swap on, and again, I reran the NEV soup test, that created way too much exposure to falling interest rates. And so we argued, and we continue to argue that we're not taking the risk off the table. Over time, this problem goes away, and we refuse to take action. And thank God we did, or didn't take action. So the other thing you can do is you can do less for a longer period of time. It's like supersized leverage. I can do a 15-year swap, and think about it. If I put on a 15-year swap today and I recalculate, you put it on at market, I recalculate my NEV or my NEV soup test in the up 300. Well, I get a 3% increase in value per year times 15 years. That's 45%. I put $100 million on, abracadabra. I get $45 million of equity in my NEV soup test. So, and back then, right, the curve was inverted. And you've heard me say this before. When the curve is inverted, do the opposite of what you think you should do. We actually got paid, right? You paid 261 for 15 years, received 270. In other words, I get free extension and it fixes my problem. I said, but if you do that, yeah, the regulators will go away. You fix the problem today, but you don't need 15-year funding. That's the problem. If you did this today, I'll show you to hedge or not to hedge. Look at this, 30-year swap today, 271. Think about it. If you put a 30-year swap on today, let's say you did 100 million. Rates go up 3% in the soup test. 3% for 30 years is 90%. You just created $90 million of fictitious value for your NEV soup test. I wouldn't do it, but you know what? There's one way out of this if you had to. All right, what else? So the other thing that, again, 50 million of a 15-year swap, I could show you 1,000 of these things, but back then we refused to do it. So even if we were to do that 15-year swap, problem solved, what problem? Now we've got all this exposure to falling interest rates. And once again, we refused to do it in our de-risking plan. We did it in a different way. So what about this? What about when interest rates hit their all-time low? This is a credit union client of mine in Maine. They had very, very, very robust 30-year fixed rate loan demand. It was all in the high rates because it's non-conforming prop. Every time we calculated this, the same credit union I showed you was an extreme risk in 2018. We couldn't afford to put on 30-year fixed rate assets because when I ran the soup test, you immediately lose 20% in the up 300. We couldn't do it. So every time we put on mortgages, we had to hedge it. And so at a cost of 59 basis points, we did it. You pay fixed 59, you receive 25. We're not there today. So unless we get, into a much lower rate environment, I am not going to suggest that you extend your liabilities, because right now, in my opinion, is not the time to do this. Unless your model shows you that you've got exposure to rising rates from a earnings at risk perspective. So to wrap it all up, NEV soup test issues uncovered. Why is this so critically important? Many of you are going to be in the midst of this. You're in the eye of the storm right now, and you're going to have to put together a de-risking plan. And you don't necessarily have to be in extreme risk. They might start asking this in the high risk category. So the trend's going to continue if rates stay the same, because we had a big backup in rates. So even if rates don't move up and June numbers come out, many of you are going to move up another category. You're going to be forced, if you go into extreme risk, to put a de-risking plan together, and fixing that fictitious, I call it, risk is going to exacerbate your risk to earnings and ultimately your capital issues. Whatever you do, right? I don't care what time of the night you call me if you decide that selling long assets is the best option for you. It isn't. It's the worst. Call me. I don't care what time. We'll get through it. NEV ignores earnings at risk, right? Especially the falling. So it's counterproductive to assessing your true risk. And again, we continue to try to educate the examiners, our clients, Federal Home Loan Bank members on the issue. This is a serious one. I would do whatever I could, right, to get through to the NCUA, get together with some of your other credit unions, write letters. But this is real. What are some of the things to think about? Should I extend funding? Federal Home Loan Bank has an option in advance that you can put on a 7-year fixed rate borrowing with the option to put it back to them at the end of the year. If you're going to do anything in terms of selling off a fixed rate, I take down the funding. And a year from now, hopefully this thing goes away, or your balance sheet changes, you put it back, right? And there's lots of different ways of getting through this issue, but I think time heals all wounds. You've got to give it time. And so you can read those at your leisure. We're right at 11:45. That's my time limit. I hope that was helpful. Let's open it up to questions. And I'm available after
Thanks
this
a lot. All right. Thanks a lot, Frank. Really appreciate it. And just to hit that point again that Frank said, if you utilize a callable advance, it helps you to buy time. So, and you should strategically use that. It may be expensive. You're taking down either a 5 or a 7-year or a 10-year callable advance, but you're taking that down to buy you time. And after 1 year and quarterly after that, you have the option to put it back. So it may be the least expensive option as opposed to selling off long-term assets or not booking long-term assets. So although it's a high coupon, gives you flexibility, and then it enables you not to make the wrong decision. Also, we have an advance called a fixed rate with a cap. We're putting the finishing touches on it. We had a LIBOR cap due to LIBOR cessation. We don't offer that anymore, but we're offering it. We're going to be soon offering one with a SOFR cap. It enables you to take a borrowing, and you may not need a large magnitude of notional value to that borrowing. You put a high cap in there. When you run your regulatory shocks, your cap kicks in. And then, again, it's something that could help you with this NEV test and helps you to buy a little time and not make the wrong decision. But Frank, one question was, what are the regulations for banks? They don't have anything like this where the regulators are dictating what your assumptions are, your non-maturity deposits. So you make your own assumptions, correct? Okay.
No. If you're reading the guidance, you're reading the guidance. Go back to 2016. Read the guidance from the NCUA, and they talk about all the things that you need to do to arrive at deposit premiums and valuations for your non-maturity deposits, right? And then they come out with this soup test, which is it's contradictory. It's contradictory. So the answer is no. And if they did, I can assure you, we wouldn't have a banking industry, and the bankers would push back like you wouldn't believe, as would shareholders.
You were talking about utilizing derivatives, utilizing swaps. So just in a quick answer, how complex is that to get approval from the NCUA in order for credit unions to embark on using derivatives?
Okay, so here's the good news. The good news is two things. the accounting rules have been significantly changed. So you can do macro level hedging now. So it's easy. As far as risk is concerned, right? As a result of Dodd-Frank, now they basically eliminated the credit risk component of doing a derivative. In terms of how easy, how simple it is, it's gotten so much easier, even versus where we were in 2018. The NCUA, the capital market specialist, said to that one little credit union that in Maine that I was dealing with, $250 million. We put those swaps on when we still have a lot of swaps on the books. They said, don't even bother. You're never going to get approved. We got approved. It was about a 143-page application back then. Today, it's easy. It's simple. So it's very easy to do. You have to get the board up to speed on this. And if you're going to do it right. Don't go to the right people. You get what you pay for. Don't try to take a shortcut and go through somebody that's the low cost derivative advisor. But it's relatively simple.
Okay. Thanks, Frank, for that. And I know you and I talk about what happens when there's volatility, and then folks get really concerned, and they tend to do things that are contrary to staying the course of what their original strategy was. In a quick answer, what are some of the key pitfalls in ALM management, especially even being in such a volatile environment? You had mentioned that we're going to be north of 350 on a Fed funds rate by year end. What are folks doing that they should not do at this point?
Well, one of the things you've heard us say over and over and over again, anybody that you've come across at DCJ, is we always say, listen to your balance sheet. When I showed you those earnings at risk, forget the NEV, earnings at risk, where's your greatest exposure and for how long? Some of us run models where we only have exposure for 1 to 2 years. We only look at 1 to 2 year horizons. We don't look beyond 2 years. Some of the modeling that we do is flawed. It's inaccurate. And so sometimes we tend to make decisions based upon flawed information. Oftentimes we don't look longer term to understand where the true risk in the balance sheet lies. And I can promise you, there's not a credit union on this call today, longer term, that has exposure to rising interest rates. And so make sure that you don't create a falling interest rate risk problem. In other words, taking action today that could come back to haunt you down the road, just like we saw in 2019, 2020. Rates go in cycles. I wouldn't, on the deposit side, we could spend all day talking about deposits, deposit pricing, betas, creating new products, tiering, rolling short versus long, rolling short with a cap to protect against rising rates. There's 1,000 different things that we could talk about, but it all comes back to your unique balance sheet. I think there's huge opportunity to take advantage of securities in today's market. They're at discounts. You can buy old coupons at discounted rates, which gives you call protection, right? But the problem with that is, as soon as you do that, it has a big impact at NEV Sup test. I don't want to extend funding to match up against it because it's too costly. And I got the prepayment risk on the other side. And all the future Fed hikes are already built into, it's already front loaded into the curve, and then some. And so it's a very delicate balance, primarily because of the Sup test. For banks, easy. Lot of strategies we could talk about today if you were a bank that I can't recommend to you with the same interest rate risk position today as a credit union, because you got that silly test. And if I were a credit union right now, I would I'd find a way to get down to Washington and get this thing changed, because it puts you at a huge disadvantage. That wasn't short, but
No, thank you, Frank. So that concludes our session today. We've answered all the questions. Really appreciate it, Frank. Great information. A lot of great ideas for everyone. One thing I wanted to note is we do have some upcoming webinars. So we have one coming up on July 14th. It's going to be we're hosting Invesco. Christina Hooper, who's a Chief Global Market Strategist with Invesco, and she's going to be talking about where we are in the business cycle, managing through rising inflation. So mark your calendars, July 14th, 11 to 12. And then we have a summer series. The next one is on August 4th with our economist, Brian Jones. And then we have someone talking about ESG, sustainable finance from Deloitte & Touche, Ricardo Martinez. That'll be August 25th. So I want to thank everyone for attending today. Again, thanks, Frank, for joining, and have a great 4th of July weekend with your families. And if you have any questions, you could always reach out to the Home Loan Bank, your relationship manager. And then also, we'll be sending this presentation out as well to the attendees. And you can, and I know Frank always has this open door policy. If you ever have any questions, either send Frank an email or send me an email or one of your relationship managers, and we'll get Frank connected with you. So have a great day, everyone. Thanks again, Frank.
Thank you. Happy 4th.
Happy 4th.